Muhammad IRFAN bin KAMAL. Today I'm going to present about Chapter 1, Introduction to Financial Management. Areas in finance. First is managerial finance. Second, financial markets. Third, investment. Then the definition of the Chapter 1, which is Introduction to Financial Management, from the perspective of S.N. Maheshwari, 2014. Financial management is concerned with raising financial resources and their effective utilization towards achieving the organizational goals. From the perspective of I.M. Pandi, 2011, financial management is that managerial activity which is concerned with the planning and controlling of the firm's financial resources. The goal of a firm is to maximize the shareholders' wealth through maximizing the price of the firm's common stock. The maximization shareholders preferred over profit maximization as objective of a firm. First, the time patterns of the returns. Even though a large return is expected in 20 years' time, very few shareholders would wait that long to get the first return for the project. Second is risk. Normally, the higher the return, the higher the risk involved. Third, dividend policy. Firm which aim only to maximize the profit will never pay dividend. Functions of a financial manager. First, performing financial analysis. Second, financial forecasting and planning. Third, financing decision. Fourth, making investment decision. And lastly, fifth, assets management decision. Definition of financial markets. It is a marketplace in which people buy and sell financial assets such as bonds, equities, and derivatives. Money market and capital market. Money market is a financial market to raise short-term financing. Meanwhile, capital market is a financial market for buying and selling of long-term debt and equities securities. Primary market and secondary market. Primary market is which deals with the new issue of securities that involve the issuer and the investor. Secondary market, after a security has been issued in the primary market, the investor might decide to sell the shares that they had bought earlier. Advantages financial institutions to the financial markets.
Assalamualaikum and hi, my name is Muhamed Syafiq Idham Bin Abdul Razak. I will present Depreciation and Taxation from Chapter 2. I will start the presentation with definition of depreciation. Depreciation is defined as the reduction of recorded cost of a fixed asset in systematic manner until the value of the asset becomes zero or negligible. A non-cash expense whereby it is just recognition of the expense as the asset is used over time. The difference between depreciation and accumulated depreciation. Depreciation, the expense is calculated for each period, but for accumulated, the total depreciation expense from the first year until the present according year. The second difference, depreciation, it is considered as an operating expense in the income statement, but for accumulated, it's found in a balance sheet. There are three methods of depreciation. The first one is straight line method, double declining balance method, and the last one is sum of year digit method. I will present for a straight line method. Under this method, depreciation is allocated equally over the estimated life of asset. For the formula, cost minus salvage value divide useful life. Example question for straight line method. Rotsy Corporation bought an instrument 3 years ago that cost 450,000 ringgit. Currently, the market value for the instrument is 300,000 ringgit, with the remaining life of span of 2 years. The company expects to gain 1 million ringgit of taxable income. Assume the marginal tax rate and capital gains tax rate of 28% and 22% respectively. Calculate the company tax liability if the instrument is being depreciated under straight line method. To solve that question, we need to calculate accumulated depreciation. 450,000 minus to 0 and divide to 5. We got 270,000 ringgit. For book value, 450,000 minus to 270,000 and we got 180,000 ringgit. For capital gains or loss, we take the selling price 300,000 minus to 450,000 and we got negative 150,000 ringgit. For calculate profit or loss, 300,000 ringgit minus with 180,000 and we got 120,000 ringgit. For tax on recapture accumulated depreciation RAD, 120,000 multiplied with 28% and we got 33,600,000 ringgit. Next, number tax for capital gains is capital loss is 0 ringgit. Tax on taxable income earning before tax EBT 1 million multiplied with 28% and we got 280,000 ringgit. Total tax liability 33,600,000 plus 0 plus 280,000 and we got 313,600,000 ringgit.
Risk is the potential of unexpected event to occur and the return is the reward we expect to get from investment. The relationship between risk and return is a probability of not realize the expected return when making an investment. Investment has a potential variability in expected return, and the bigger chance of returns, the greater the risk. These are methods to reduce the risk. First method is a take up insurance policy to protect against risk. Second method is a diversity the asset portfolio, and lastly is to reduce the volatility of sales and fixed costs. Let's see at this simple question. I will show how to calculate risk and return. The question: the cash flow of two projects under three economic conditions. And from the table, we can see a probability and return of two projects. For the first step, we need to find the expected return, and the formula to find expected return is probability times with return. As we can see at the table, I already make the calculation for each probability and return. And the answer that we get, we need to total up so we can get the total expected return. We need to do to both projects. For second step, we need to find the variance, and the formula for variance is a probability times with return minus expected return square. That is a square, not times with 2. On the table, the calculation has made same with the expected return. We need to total up the answer for each probability times with return. After we total up, we can get the total amount of variance for both projects. For the next step is a standard deviation, and the formula to find standard deviation is mean square the answer that we get from the variance. As we can see, for project AIZAT, the variance for project AIZAT mean square, and the answer is 50,508. For project VEZA, mean square the variance for project VEZA, and the answer is 20,273. For the last step, we need to find a coefficient of variation, and the formula of coefficient of variation is a standard deviation divided with expected return. As we can see at the table, the CV for project AIZAT is a 0.73 times, and CV for project VEZA is 0.78 times. So, after we find the coefficient of variation, we can conclude that the company or we need to choose a project AZIA because project AZIA is less risky and has a lower coefficient of variation than project BEZA.
Okay, hi, Assalamualaikum. My name is Muhammad AIZAT bin SAAD. Okay, today I will present about chapter 5, which is cost of capital. Okay, first I will state the sources of long-term financing. Okay, first debt or bond. Second, preferred stock. Okay, lastly, common equity equal common stock plus return earning. Okay, next I will explain about the different amount of sources of long-term financing. First, for definition of bond is long-term promissory note issued by the firm. Second, definition for common stock is represent ownership position in the firm. Okay, lastly, definition for preferred stock, which is hybrid security with fixed dividend but without maturity period. Okay, next, different based on maturity value. Okay, for bond, RM1000 unless stated differently. For common stock, RM1 unless stated differently. For preferred stock is RM100 unless stated differently. Okay, next, different based on has maturity period. For bond, yes. For common stock, no maturity period. For preferred stock, also no maturity period. Okay, next, different based on liability or equity. Okay, for bond is a liability. For common stock is an equity. For preferred stock also an equity. Okay, next, the difference based on tax deductible. Okay, for bond, yes, have tax deductible. For common stock, no. For preferred stock, yes. Okay, next, different based on periodic payment is called. Okay, for bond is interest. For common stock is dividend. For preferred stock also dividend. Okay, next, different based on the is payment in fixed amount. Okay, for bond, yes. For common stock, no. For preferred stock, yes. Okay, next, is it compulsory for the issuer to pay the periodic payment? For bond, yes. For common stock, no. For preferred stock, yes, but can be accumulated in the future due to having financial difficulty to pay dividend in the current year. Okay, next, different based on voting right. Okay, for bond, bondholder does not have the voting right. For common stock, common shareholder has the right to vote. And lastly, preferred stock, known only during a financial distress. Okay, next, hierarchy of claim on income. Okay, first bond, second preferred stock, and third common stock. Okay, lastly, hierarchy of claim on asset in the event of bankruptcy. Okay, first bond, second preferred stock, and lastly common stock. Okay, after that I will explain about meaning of weighted cost of capital WACC and weight marginal cost of capital WMCC. Okay, first, weighted average cost of capital is a method used to find the overall cost of financing through the combination of at least two sources of financing, and proportionate weight is assigned to each sources of financing. Okay, next, weight marginal cost of capital is a method used to find the cost of capital when an additional amount of capital is raised. Lender may increase the cost of debt when the debt amount exceeds certain limit. Finally, I will show you how to calculate the cost of each sources of financing. First of all is bond. Okay, you can see at the calculation method on the slide. Second, cost of issuing preferred stock. And lastly, common equity. Okay, that's all from me. Thank you.
Assalamualaikum. My name is Muhammad HELMIZI bin Muhammad ZAIIDI. So today I will present about one of the chapter in FIN 320 subjects. I will explain about chapter 6, operating leverage and break-even analysis. Definition: fixed operating cost. It does not vary proportionately with the levels of sales. It remains relatively constant regardless of the increase in the sales volume. For example, rent, insurance premium, and property taxes. Variable operating cost. It moves directly with the level of output. The cost increases as output increase. For example, selling commission, cost of raw material, and direct labor cost. And lastly, operating leverage. It is the responsiveness. And lastly, operating leverage. It is the responsiveness of earnings before tax. And lastly, operating leverage. It is the responsiveness. And lastly, operating leverage. It is the responsiveness of earnings before interest and taxes EBIT to the changes of sales volume due to the use of fixed costs by the firm. Degree of operating leverage DOL. Degree of operating leverage DOL is the percentage changes in EBIT resulting from the percentage change in sales. There are three formulas to measure DOL. First, DOL percentages change in EBIT divided by percentages change in sales. Next, DOL sales minus variable cost divided by sales minus variable cost minus fixed cost. And lastly, DOL sales times price per unit minus variable cost per unit divided by sales times price per unit minus variable cost per unit minus total fixed cost. Note, a DOL greater than 1 indicates that the firm has operating leverage. Example question for degree of operating leverage DOL. Kokoro Construction expects its sales to increase by 15% next year. If this year's sales are 1 million ringgit and the operating leverage is 1.56, what is the expected level of operating income for next year if this year's operating income is 412,000 ringgit? So the answer is DOL percentage change in EBIT divided by percentage change in sales. So 1.56 percentage change EBIT divided by 15% equals to 23.4% equals to change in EBIT. EBIT this year equals to 412,000 ringgit. Then EBIT next year will increase by 23.4%. So EBIT next year equals to 412,000 times 1.234, which is 23.4 over 100 plus 100 over 100. And the last answer is RM 508,408. Next, definition of break-even analysis and list of formulas. Definition. Break-even analysis is a method used to determine the level of sales that a firm must reach to cover its operating costs. Next, list of formulas. A. Total sales equal to sales volume per unit times price per unit. B. Total cost equal to fixed cost plus variable cost unit times sales volume. C. Operating profit divided by operating income divided by EBIT equal to total sales RM minus total cost. D. Break-even point RM equals to BEP per unit times price per unit, or fixed deposit divided by sales minus variable cost or sales. E. Break-even point unit equals to fixed cost divided by price per unit minus variable cost per unit, or BEP RM divided by price per unit. F. Degree operating leverage DOL equals to sales minus variable cost divided by sales minus variable cost minus fixed cost equals to times. Example question for break-even. Decor company manufactures and sells sport jackets. Each jacket is sold at 350 ringgit. Fixed costs are 500,000 ringgit and variable cost is 100 ringgit per unit. The current sales are 3,000 jackets. Annual depreciation expense is 40,000 ringgit. Calculate. So the answer is A. Break-even point in unit equals to 500,000 divided by 350 minus 100 equals to 2,000 jackets. B. Break-even point in ringgit equals to 500,000 divided by 350 minus 100 divided by 350 equals to 700,000 ringgit. C. Break-even on cash basis equals to 500,000 minus 40,000 divided by 350 minus 100 equals to 1,840 jackets. D. break even at a predetermined level of profit if the targeted profit is 100,000 ringgit equals to 500,000 plus 100,000 divided by 350 minus 100 equals to 2,400 jackets. And lastly, break-even margin equals to 3,000 times 350 minus 700,000 divided by 1,050,000 ringgit equals to 33.33%. So the current sales can decline by 33.33% before hitting the break-even point. So that's all from me. Thank you.